Good afternoon, everyone. This is Kevin Kincaid, and I will be your host for today's webinar entitled The 4 Stages of Military Life Insurance. Our presenter today is Carlos Perez, Assistant Secretary here at AAFMAA. In addition to his role, Carlos is a longstanding AAFMAA member and a retiree of the United States Army. We have a few slides for you today, and we'll be talking for about 20 to 30 minutes. Then Carlos will answer questions from the audience. Please note that your phones will be muted throughout the entire presentation, so if you have a question, please type it into the questions block on your screen at any time, and we will address as many as we can at the end. So AAFMAA stands for American Armed Forces Mutual Aid Association and is the longest standing not-for-profit association that empowers military families with affordable financial solutions. We accomplish this by being the premier provider of affordable life insurance, expert investment management, customized residential mortgages, and our exclusive survivor assistance services, all for the military community, not for profit. Here's an important disclaimer. This presentation is educational. It is for general information only and is not specific insurance, investment, legal, or tax advice for any of you individually. Do not rely on this presentation alone to guide your financial decisions. Each individual situation is unique, and your decisions will not necessarily be the same as other service members or veterans. For individual advice, please contact us directly. We produce this webinar series in-house with our own professional staff as a service to our members and to help them better understand the resources that are available to them. So now I'll go ahead and turn it over to Carlos, who will review the agenda.
Thanks, Kevin, and good afternoon to everybody in the audience. I appreciate you taking some time out of your day to learn a little bit more about what I think is a pretty important topic. A lot of times we get advice in life to reassess, relook your finances, relook your professional goals. Rarely do we take the opportunity to relook our need to protect others that are dear to us. And that's what today is all about, is understanding that as you transition through life, in particular, we're going to talk about 4 stages today. What worked for you when you were at one point in life may not work for you later. So this is what today is about. And we're going to walk through 4 transition points, beginning from early, single, young professional, all the way through to retirement. And along the way, we'll discuss what type of products make sense for that point in life. So next slide.
There we go. We'll go the right direction.
Great.
There we go.
Yeah, so we have a nice little graphic here of, we all start out at the top left and we all end up at the bottom right. And the question is, where are you today? What cycle are you in? And just to help us get to know you, the audience, a little bit better, we have 2 questions we're going to throw out at you as a poll. The first one just asks you to tell us a little bit about who you are. And that is, tell us, are you presently serving? Are you separated? Are you retired, or are you a family member? And I see the results coming in. Okay, it looks like we have about 3/4 of the audience is retired and a quarter presently serving. Great. So that's great. That's the first part, is knowing where you are in life cycle. And I know that sounds kind of funny, but it is important, as you'll see in a few minutes. The second question is quite simple, but also incredibly important. And that is, does anybody depend upon you for income? So, Kevin, if you put that out there, let's see what our folks say.
Sorry, I know one.
Yeah.
Technical difficulty. There we go. This is a very live webinar.
There we go. There you go. So you should be able to answer the poll. Does anybody depend upon you for income? Yes or no? All right. It looks like coming in, and looks like everybody in this audience. This morning we had a little bit of a different split. We had about a 90%, 10% split, but here it looks like everybody dialed in and said, yes, somebody depends upon me for income, and that is the most important question you can ask when it comes to insurance. So let's look at some of these life cycles now and see how these questions matter. We all start out young. Here's a nice little bright-eyed millennial there on the left. I'm the proud father of a couple of millennials, and if anybody out in our audience is a parent and has millennials, you'll know what I'm living through right now. But they're great, right? But here we are. We're young. we're starting out in life. We may have our first job, starting out our profession, not married yet or no family yet. So the question is, does this person, who is analogous to a brand new service member, need insurance at all? And the gut reaction from people is no. Why bother with insurance? Nobody depends on my income, so I really don't need this expense. What we find is that even for somebody who is starting out, some amount of insurance does make sense, specifically to cover things like burial expenses and expenses that occur upon death. When you pass away, somebody's going to have to pay for your casket, for your funeral, for the cemetery. And those expenses, a casket today starts at about roughly $10,000. And when you add on those other costs, you're looking at 3 to 4 times that amount, quite a substantial amount to have to pay up all at once. And so even if you're just starting out and have nobody dependent upon you, some amount of insurance to cover those expenses makes a lot of sense. In addition, not shown on the slide is another important factor, and that is that when you're young, you're as healthy and as young as you'll ever be. And so because of that, your insurance rates are probably as low as they'll ever be. So a second reason, although not as compelling, but a second reason nonetheless, is you may want to purchase insurance at this stage in life because you can lock in some fairly low rates on coverage for you. So that's the first stage, pretty straightforward. But then, as happens for many of us, life gets a little bit complicated, and we may get married, we may have a family, have some children. And this is an incredibly important transition point for us, because now it's this part of life that we really see some large expenses come into the picture. This is when we may be looking at buying a house or actually buying a house. This is when we need to pay off our college funds if we have college debt. This is a time when it comes due. In addition, if you are starting a family and have children, this is when you want to be able to start putting money away to pay for that. And you may also want to start building your nest egg. And these expenses can be quite large. Now, the good news is for our audience, if you are in the service still, you have SGLI, and SGLI provides a good amount of coverage, $400,000 at a really affordable rate of about $28 a month. But the thing to remember about SGLI is that second bullet there on the right, that you lose it when you separate, and it might not be enough. And we're going to come up to that aspect of it in just a little bit.
Great. So Carlos, real quick, we talk about SGLI a lot and the features of it, but one of the questions we hear from our members a lot is SGLI mandatory for service members?
Yeah, that's a good question, and it's one that we address once in a while in correspondence with members. SGLI is an excellent coverage that's provided as a benefit to service. But the reality is that you can decline it. In fact, you can decline some of it or all of it. And if you decline it, we still would encourage you to consider the fact that you probably need some kind of coverage at this stage. Now, some people decline it because if you were to shop around, you might find that you can get coverage that's equivalent to SGLI at lower rates. And in fact, one of our policies here at AAFMAA, the Level Term 1 policy, is designed specifically to provide this kind of coverage at about $10 less a month, and it comes with our survivor assistance service, which is something unique to AAFMAA, and that is having somebody that can walk you through the process, your beneficiaries actually, through the process if a death occurs, and make sure that they get all of the entitlements that you have earned. But great question. So when we're looking at insurance now at this part of life, one of the things that we're seeing is that there's reluctance by the general public to do research and to really try to understand their needs. And McKinsey & Company, a very reputable consulting company, did a study not too long ago, and it found that most people find researching and buying insurance extremely unpleasant. And the reason is, one, the reason there that's shown on the screen, which is we really don't like to think about death and what happens to us and what might happen to our family. And the other reason not shown on the slide is that insurance products could be complicated. And if they're hard to understand, it makes us less inclined to really try to analyze it and determine if it's something we should do. But as I hope people understand that are participating with us today, it does matter. And the whole reason we're doing this webinar today on this topic is to help explain these different types of insurance policies to our members. So let's go ahead and look at this. I mentioned earlier that when you're young and maybe starting to undertake some of these changes and incur these large expenses, you need a policy that's affordable. And so at this stage in life, the type of policy that makes most sense is a term policy. SGLI itself is a term policy, but there are many others out there provided by companies such as AAFMAA. And the benefit of having a term policy is that you can get a relatively large amount of coverage for a relatively low cost, low premiums. And the way these work is working with your insurance company, you select a time period or a term that you want coverage for. Usually this horizon should cover those expenses that you're trying to meet. So for example, if you get a 20-year mortgage, you probably want to get a 20-year term policy to cover that mortgage. And so you pick the term and you pay the premium, and while you pay that premium, you have life insurance. Now, if you outlive your policy, the good news is you've outlived your policy, right? You're alive. The bad news is that you do lose coverage at the point of expiration, so you'll have to think about replacing it if you still need policy at the end of that time horizon. But term life insurance, a great option for covering large expenses at a relatively affordable way.
Great. And Carlos, real quick, part of what you mentioned there in the needs case is really protecting your dependents, your spouse, your children. And so another question we get quite often is about, should I have dependent coverage? Should I have coverage on my spouse and my children? Is that a smart thing for me to do?
Yeah, that's a good question. It's one that we also get quite often, and so I'll talk about that in two aspects. One with regards to insuring a spouse, and then with regards to insuring children. So if you'd hit the next slide, please. Let's talk about the spouse first. This is one that we, myself included, can overlook, especially in the case of a stay-at-home or a work-at-home spouse. But if you think about what that spouse does, and think about having to replace that, it can be pretty substantial, right? This is a person who cares for children. This is a person who may provide transportation for children. This is a person who cares for the home, coordinates the activities of the home. And if you were to have to replace those as a service, it could actually amount to quite a bit of money required to do so. So we do recommend some amount of coverage, and it's different for every family, and our member representatives would be happy to help folks in our audience kind of go through this. But in many cases, it does make sense to insure a stay-at-home or a work-at-home spouse because of the fact that you probably would have to replace some or all of the services that they provide to your family in the home. One way to do it is through family SGLI, which is available to service members, up to $100,000 of coverage. But you can also buy term policies from other insurance companies, anywhere in a range from $50,000 to $100,000 to as high as $800,000 or maybe even $1 million, depending on the insurance company's policies. But the short answer to this question is you should consider insuring a spouse even if they're stay-at-home. The harder question, I think, is should we insure a child? And the reason is that clearly a child has no income-generating potential, really, in most cases, for a family. And at worst, some people just view this as a wager on a life, and certainly we don't think that's the case or that you should look at it that way. I look at this the same way I looked at that young millennial, and that is if my child passed away today, not only would that be an incredible emotional event, but it would also be potentially an unplanned large financial burden on a family. And so for that reason, it does make sense to consider some insurance. And in fact, I have 4 children and I have insurance policies on each child for this reason. But the other reason mentioned in the case of military millennial applies here as well, and that is that children are young and healthy. If you can afford a policy for a child, you can lock them in usually at extremely low rates and provide coverage for a child that could last them potentially for the rest of their life. A good example here at AAFMAA is our Generations Plus policy designed for children, where you can buy a policy that provides coverage, and then over the life of that policy, you have guaranteed purchase options to increase the amount of that policy, and at the end, really significantly much more coverage at a relatively low rate than what they started out with. So again, child coverage does make sense if you need to provide for covering the costs of funeral or burial. Now the stage that none of us ever thought we would get to in the service, but we all do, and that is at some point we all leave the service. As Kevin mentioned, I'm a retiree from the Army, but this applies to those even separating after a term or a few terms in the service, and that is that when you leave the service, you will lose your SGLI. And as I mentioned already, that is a good benefit that the department provides for service members. It's a good policy. And what we find for people at this stage in life, especially if they're a little older, and by that I mean in their 30s, maybe approaching their 40s, you still have some of those large expenses lingering out there. But you may have paid down some of that mortgage. You may not have saved for your child's college. So you may not need as much insurance, but you probably need some insurance at this point still, because if you were to pass away, you would still need to pay those expenses. So term insurance makes sense here, but this is also the time to consider permanent insurance, and I will cover permanent insurance here in just a little bit. But before I go there, I do want to cover two options available uniquely to service members, and that is that you can opt into the Veterans Group Life Insurance Program when you leave, and you can also, if you are a retiree, opt into the Survivor Benefit Plan. So we'll talk about VGLI first. We get questions about VGLI very often. VGLI is a term policy, just like SGLI, but it's a little different in that it's renewable every 5 years. And so you can get insurance for amounts as low as $10,000 or as high as $400,000 like SGLI. And what's important about VGLI is that red bullet there just below the center of the page, and that is if you opt into VGLI within 240 days of leaving the service, there is no medical underwriting, no medical insurability requirements, and that is a really important feature of VGLI. You have over a year, you have a year and 120 days to decide to opt into it, but if you opt into it within that first 240 days, there's no medical requirements. And so what this means is, if you think about this, this is great if you have a medical condition, right? But what we find as a rule of thumb is that if you are in average or better health, it does pay to shop around and compare the VGLI rates you would get to a term policy you could get with another company such as AAFMAA or any other reputable insurance company. Because the fact that VGLI must accept everybody within 240 days means that they are incurring risk. And the risk that they're incurring is that they are accepting not only healthy people, but people that are sick. And the way that they factor in and account for that risk is through premiums. So if you go to the next slide, you can see their premium structure increases dramatically as you age. So the first row is the SGLI premium of about $28 a month. If you opt into VGLI at age 40, that more than doubles to $68 a month. And then you can see it rapidly increases so that in your 60s, you're looking at $600 and then even higher as you age. So VGLI is good in the sense that it will cover you if you need insurance and nobody else will insure you, but it is very expensive coverage. And as a comparison, on this next slide, I've shown the VGLI rates in that second column, and then the next 5 columns are AAFMAA's rates for different health classes, the healthiest on the left under Super Select, and the least healthy on the right at Class 2. Most people that come in for a policy in AAFMAA fall into the Select category. And then at the very far right is a comparison with another company. So what does this show you? Let's just say you're 50, about the age of retirement from the service, and you're considering VGLI. You'll see right away that it is more expensive for you to do that, except in the case where you are very, very, very unhealthy in Class 2. But as you age, you can see that those rates become superior to the VGLI rates. So if I'm a Select category person, I pay $95 a month for the entire term of this policy, whereas I would pay as much as $920 a month if I lived to age 70. And even the comparison company after age 55 is superior to VGLI in terms of monthly rates. So again, the message is If you're healthy, average or better health, shop it around. If you think you have medical problems that might cause you to be rejected for insurance, then VGLI might be a good option for you. The other option that you have, if you are a retiree from the service, not if you're separating, but if you're a retiree, is you can opt into the survivor benefit plan, where you give up a percentage of your retirement pay each month as a premium, essentially, and that gets your spouse a monthly benefit for the rest of his or her life. And so here's an example. A sergeant major at 30 years in retirement would earn about $51.59 a month. If he maxes out SBP at 6.5% of retired pay, that premium is about $335 a month. And if this sergeant major passed away, his or her spouse would get about $2,800 a month. The question is this a good deal? Well, if you compare SBP to life insurance, you'll see that it has some favorable features, right? It is lifetime coverage, premiums are pre-tax, and your age and health don't factor in. The downside is that it really is only for a spouse, and I know that you can also choose for children as well, but most people opt for SBP for their spouse. And insurance, on the other hand, of course, you may have a fixed sum benefit. It's not COLA adjusted. You don't get tax breaks on the premiums, and there is underwriting, but you can change your beneficiary. So if you're paying into a policy for a long time and you want to swap it out, you can. What we find is that while circumstances are unique to every member, the general rule of thumb with SBP is that if you're a primary income earner as a service member, the longer you think your spouse will outlive you, the better deal SBP is. And in most cases, it is a good thing for service members to opt into. We find, in my case, for example, my break-even point with a comparable insurance plan was about 5 years. So I personally believe that my spouse would outlive me by more than 5 years, and so I opted into SBP. And so that's a good way to think about it. Now, so this third stage of life was this transition from service, and the message here is some type of insurance to replace your SGLI makes sense, probably a term policy, but you ought to consider some type of whole life coverage, some type of permanent insurance, which takes us now to our final stage, and that is retirement. Retired retirement, which is, our goal, at least it's certainly my goal, and that is to someday just be done working and enjoy life to its fullest. At this stage of life, most people are really focused on a few things. One is those final expenses, right? How do I set myself up so I don't burden my family when I pass away? But at this point in life, I'm also thinking about accumulating wealth and having income available if I need it, because I probably am no longer working and earning income, and that's important. And whole life insurance makes a lot of sense for this demographic. And I have an example, but I'll come back to that example here in just a minute. But the bottom line is, at this stage in life, you should be considering some type of a whole life insurance.
So, and Carlos, one thing that we also hear a lot from our members is, the term whole life insurance, is that the same thing as permanent insurance? And what makes it permanent?
Great question. And again, as I mentioned earlier, insurance can be very confusing, and one of the reasons is all these names we throw around. But permanent insurance is whole life insurance, or more precisely, whole life insurance is a type of permanent insurance. And what makes it permanent is that as long as you are paying the premiums or have paid up the policy, that policy is effective until death, and that's what makes it permanent. So how does this work? These policies, you pay a premium, and the premiums that you pay accumulate cash value, and that's an important feature. Because of that, because they grow in cash value at a crediting rate offered by an insurance company, you can do stuff with that cash. One, it provides the basis of your protection under the life insurance policy. But two, you can access it. So you can borrow against that cash value, or if you really needed the cash, you could cash it out. These proceeds pass tax-free to the beneficiary. And usually these amounts, because the policies are more expensive, what we see is, unlike term policies, you typically have smaller face amounts, and the premiums are a little bit relatively higher. The other incredibly important feature of many of these policies is that they have something called an accelerated death benefit. And what that is that the IRS allows an insurance company to essentially pay proceeds of the policy while somebody is alive if they meet a certain condition. And the example that I have here is AAFMAA's example of long-term care settlement. AAFMAA offers a long-term care settlement option with every whole life policy. And what this means is that if you are somebody who is certified by a medical provider as not being able to meet 2 of the 6 conditions of daily living, things like eating, bathing, etc., then AAFMAA can pay you the proceeds of your policies, and we pay it at 2% a month for 50 months to help you meet those expenses associated with long-term care. We also see this sometimes with other companies, but not in AAFMAA's case, in the case of a terminal illness, well, they'll do something very similar. But this is a great benefit that people often overlook, and that should factor into somebody's plan. So let's come back to our example here. The example I'm using is what we call Wealth Builder at AAFMAA, and this is an insurance policy that you can purchase. You pay a net single premium one time of $7,690, and that gets you $10,000 of insurance, and you can add increments of $10,000. And with that premium, you immediately have life insurance. So the first thing is you are protecting your family with insurance. But the cash the premiums that you make against this policy grow, in our case, this year at a crediting rate of 6% a year, minus an administrative fee shown here. And as that cash grows, as I mentioned earlier, you can borrow against it if you want to. But this policy has another neat feature, and that is, remember I said you build wealth so that you can cover expenses and generate income if you need it. You can take the cash value of this policy, you can annuitize it, and receive a monthly stream of payments until age 100. So a really neat feature and a good example of how a life insurance policy, a whole life insurance policy, can provide not only protection for your loved ones later in life, but can also provide you some benefits in terms of building wealth and having cash if you need it, either in an emergency or just because it's part of your plan for your income later in retirement. So that's the 4th stage, Kevin. And what I'd like to do is pause there and see if we have some questions coming in and take those, and then we can wrap.
Yeah, thanks, Carlos. And that was really informative. I hope everyone out there in the audience listening got a lot out of that. We are going to open it up for questions now. We've collected a couple of questions already, but please don't hesitate to submit your own questions by typing them into the questions block on your screen. As Assistant Secretary, Carlos oversees the AAFMAA Life Insurance business as well as all member-related issues. So why don't we go ahead and get started with a couple of these questions that have come in. The first one is a question about who you can insure. Are there any restrictions on who you can insure?
Oh, good. Thanks, Kevin. Good question. And I can read that question 2 ways, so I'm going to answer it 2 ways. First one is I'm going to read it in terms of, are there any restrictions on who AAFMAA can insure? And the answer to that is, AAFMAA is a member-owned association, so we can provide our services and products to military, veterans, or their dependents, their family members. But the other way you can read this question is, who can I buy insurance for, right? Who can I insure? And what the law requires is that you must have an insurable interest in the life you're insuring. And what that does is that eliminates, by law, wagering on people's lives, right? So I just can't say, hey, I think that guy's going to die, I'm going to take a policy out on his life, and then when he passes away, I'll become rich. The law does not allow that. That's illegal. But you do have an insurable interest in a spouse, if that spouse is a primary income earner, and the law also recognizes insurable interest in children, parents, siblings, and in some cases even businesses may have an insurable interest on a person if they're a key leader or a key officer of the association. So very good question. The short answer is there are restrictions on who you can insure, and generally you must meet the test of it being an insurable interest on your part.
Great. This next question, and it goes back a little bit to what you were talking about before about how talking about life insurance, talking about our mortality is not a fun thing that anybody wants to do, but it also creates a little bit of mystery around how the process works. And so this question, I think, gets to that. It's, can you explain how payouts work, I guess, when a policy gets claimed?
Yeah, good question. I'll start the answer to this question with just pointing out something that I referenced earlier, and that is one of the unique things that we offer here at AAFMAA is survivor assistance. So when you pass away, you can just know that they'll be taken care of because our SAS reps, our survivor assistance reps, will walk that beneficiary through the entire process and help them with all the forms, and we'll even do that in helping them process any VA type of items and help with other insurance companies as well, even if they're not AAFMAA. But in general, when somebody passes away, we're obligated by law to do two things, and that is one, more than two things, but the first two things are we have to confirm the death, and we usually do that through a death certificate, so we will ask for a death certificate. And then we will go back into the file of the insured and see who they designated as a beneficiary. We'll confirm that person's identity, and then we'll go over the settlement options with that person, and then pay out according to the options that they choose. They can choose to receive the proceeds as a lump sum. They can receive it over time as an annuity. They can leave the lump sum at work for them here and just take the interest payments on it. So there are a few options for them, and then once they decide, we pay out the policy. If a death occurred within 2 years of issue, we do have some requirements to review the policy, and we do that. But in general, the process is as I've described it. One other thing to point out is that as the owner of a policy, you can actually restrict how the beneficiary would receive it. So you might say, I want to leave this policy proceeds to my son, but I want him to only get interest, or I only want him to get it as an annuity. You can do that, but we generally advise against that because we would encourage you to give that beneficiary the greatest flexibility because circumstances change and needs change. And so we think flexibility is a little bit better, but you can do that if you want to.
Great. So this next question it's a great question, especially our audience, I think, is about, we saw 2/3 retired. So there's a high likelihood that a lot of people already have some kind of life insurance. Can I transfer a life insurance policy from one company to another, say, like, I don't know, AAFMAA?
Yeah, that's a good question. And we get that one, get it a lot, as the saying goes. The answer is no, you can't transfer a policy. The more precise language is that you can exchange a policy. And the way this works is that the IRS does allow somebody to take a policy and conduct a tax-free exchange for a similar policy with another company. The reason they do this is it allows you to maintain that protection and not have to incur a tax burden. For example, if I have a whole life policy today, and I do, I could just cash it out, take the proceeds, and go buy another policy on my own. But if I did that, then I would have to pay taxes on any gains over my premiums that I've paid. So that's why this is important, that the law says if you're going to keep coverage, you just want to get a different or a better policy. The way to do that is through what's called a 1035 exchange, and that name is just based for the IRS code section that it falls under.
Great. And so one other question that's just come in, and it does go back to that difference between whole life and term, and you just kind of mentioned this just now, but can you borrow against a term policy?
That is an interesting question, and I didn't say good question. I said it's interesting. No, I'm just kidding. It is a good question, and this is one we get a lot, and we're being very precise because the question refers to a term policy. If you own a term policy, it is analogous to an auto policy where I pay a premium every month to my auto carrier, and I have insurance for my automobile. But when I'm done with that policy or I sell my automobile, I don't get any cash back per se of the premiums I paid for my auto insurance company. Term policies are the same. You pay a premium, it's very affordable, and you have insurance coverage while you're paying premiums. That's the benefit you get. But term policies do not accumulate any cash value. Now, if you had whole life in that question, can I borrow against my whole life policy? The answer is yes. You can borrow against the cash in a whole life policy. AAFMAA will allow you to borrow up to 75% of the cash value. And what this does, again, is it provides flexibility to the owner, especially if you are one of those in those later stages that we talked about that have this kind of policy for that very reason. And if you have a loan out and you were to pass away, there's no burden passed on to your beneficiaries, because what we would just do is deduct the unpaid balance of the loan and then pay out the rest of the policy to whoever you designated. Good question.
Great. It looks like we have one more question here. Would it make sense for a young person to get one of the wealth builder policies that you were talking about before?
Good question, right? Because if I have a product that allows you to accumulate wealth, why not get it when I'm very young? The answer is it might make sense. And the reason is that some life insurance policies, based on their term, how long they are and how much money you pay into them, might be considered what's called a modified endowment contract by the IRS. And they do have some tax implications and tax penalties if you withdraw or borrow against them early. So the Wealth Builder policy I described earlier is a life insurance policy, but it is considered one of these MECs. That's the acronym for that type of policy. And so if you buy them and you're very young and you were to borrow or withdraw the cash out of those policies before age 59 and a half, not only would you pay on gains, but you would also pay a 10% penalty as well. So it might not make sense in that case. Now, if you wanted it just as an insurance policy and you knew that they were never going to take out the proceeds, any of the cash value, then sure, it would be fine. But just know that there are some tax circumstances. Let me take a look and see if we had any others pop out here. And if we don't get to your question, we'll just reach out to you individually. The first question has to do with tax implications of whole life policies. So I'll just talk broadly. Number one, if you were to cash surrender a policy, there are tax implications. You must pay taxes on the gains over your premiums at whatever tax bracket you're in. And if it is a MEC, a modified endowment contract, you also may have to pay that penalty I just talked about. If you borrow against a policy and it's not a MEC, there's no tax implications at all, unless you don't pay the interest. If you don't pay the interest, that capitalizes and you would owe interest on that amount. But in general, loans under normal circumstances aren't taxable.
The next question that I'm seeing here in the block is a healthy female. She has a 10-year policy that is coming close to needing to be renewed. She will be at, it looks like 71. So can she renew for an additional 10-year policy, and will the premium be the same?
Good question. Very good question. So most term policies, by definition, expire at the end of their term. The only way that you would be able to renew it is if there is a specific renewal clause in that policy itself. So for us, in our case, if you have, for example, an AAFMAA level term 2 policy, there is no renewal. If you have some of our other policies allow you to convert some aspects of it. We do have some policies that are specifically renewable, but that's in the terms and conditions. So long-winded way of me answering the question, and that is if it's a regular, so to speak, term policy for a term of 10 years, it is likely that it is not renewable. But that doesn't mean there aren't good options for you. And you know, at this demographic, I might look at something like that Wealth Builder policy because it has very limited underwriting. It has 3 questions to answer, and you can get an insurance policy that builds cash value and grows wealth. So you know, whole life policies, my opinion in general, is that they've got a bum rap over the past few years, but they really do serve a purpose. Even I have a whole life policy. I have one for my spouse as well. So they serve a purpose, and I would encourage people not to just discount them wholesale. Kevin, I do want to do one thing. I have a question for the audience,
yeah,
and it has to do with insurance coverage and insurance gap. So I've taken their questions. I want them to take one last question from me, and that is there was a study recently done regarding insurance coverage that people have versus what they might need. And so I just want to ask you, the audience, if you had to guess what that gap is between the amount of coverage people have and the amount of insurance that they need, would you say it's in the $100,000 ballpark range, $200,000 ballpark range, or $500,000 ballpark range? Let's see. Ah, this is interesting. We have a fairly even split here between 200,000 and 500,000. The morning's audience swayed heavily to 500,000, but the answer is 200,000. The data out there suggests that about half of all American families are underinsured by about $200,000. And this goes back to all those reasons we talked about why people don't get insurance. It's confusing. I don't understand it. It's expensive. What I hope people have seen here today is that there is value in insurance, that some products are better than others at different points in time. And so I'd like to just wrap up with that, and that is look at your needs if you have a gap in insurance, then for your family's sake, do something about it, right? You'll be gone, it won't matter, but your family will have to then pick up and deal with any of those shortages, any of those gaps. Secondly is your needs do change over time. If you're single and you're young, some insurance for cost of burial or insurability makes sense. As life starts getting more complicated, as I like to say, you probably need more coverage at affordable rates. Term insurance makes sense for those people. As you transition, remember, you may need to replace your SGLI. Most people do, so don't forget about that. And you don't have to wait. You don't have to wait until the year you're retiring or separating. You can do that a few years out. In my case, I did it about 3 years away from retirement. I replaced my SGLI. And then as you go and approach retirement, that's the time to think about some permanent insurance, because it can help you not only provide protection for those you love and meet final expenses, it might also help you build wealth, and it could even provide a stream of income should you need it in those later years when you're not working.
That's great. Thanks again, Carlos. I'm going to put your beautiful picture up here and your contact information. So thanks again for those great questions. If we didn't fully answer your question, or if you think of another question later, please reach out to us at membership@AAFMAA.com. We have recorded all of the questions that were submitted, and we know who you are if you ask the question, so we will be able to get back in touch with you directly, and we will make sure to do that. We'll go ahead and break here for now, but you can reach us anytime that you need to. Please don't hesitate to reach out to us for assistance. We do this every single day for our military community, and it is our pleasure to do so. This weekend, you'll receive a follow-up email with instructions on how to access a recording of the presentation. And you can always register for future webinars or review past webinars at afma.com/webinars. Speaking of future webinars, please be sure to join our colleagues over at AAFMAA Wealth Management and Trust on September 14th. Their Senior Relationship Manager, Ross Cutler, will be producing a webinar about the difference between financial planning and wealth management. So it should be very informative, and I encourage everybody to try and tune in for that. If you found this webinar information useful, we encourage you to please share it with your friends and family. Our membership grows stronger every year because you introduce your military community to AAFMAA. Thank you again for joining us today, and we look forward to our next opportunity to assist you.